Okay, welcome to Chapter 3 for Accounting 470 Nonprofit. What ended up happening was that for purposes of this video that I'm posting to YouTube, I forgot to hit the record button until we got to Learning Objective 2. So there's going to be a little bit of a disconnect. What I've done is I've gone back and recorded separately Learning Objective 1, and I'm going to put it at the beginning of the video, but you'll see that it won't be a smooth transition from Learning Objective 1 to Learning Objective 2 because I started the original video at Learning Objective 2, and now I'm going back and adding Learning Objective 1 at the beginning. So let's go ahead and jump into it. Here we have our learning objectives, and we're going to be talking first about government-wide expenses and revenues. I just want to point out that we're doing it slightly different this week, and hopefully everyone will. This was at some students' request that I do it where I provide the outline ahead of time with some fill in the blanks and also the questions at the end. The outline is available on D2L, so it's probably best to download it or to print it either way and watch and read along with it while we're going through the video. But that's the reason why there's not a whole lot of text on the right side of the screen, because the intention is that you have the outline already in front of you, whether on screen or in paper. Now over here I have a couple of I've got a couple of bullet points. These are the main bullet points of each learning objective, and what you'll see is that there is a italicized word. The italicized word is one of the fill in the blanks. It's not the very first one. The very first one is government-wide. So at the top it says reporting of expenses and revenues at the government-wide level, and then self-financed is kind of down. It's the second fill in the blank. So you can go ahead and fill those in, or you can listen to the conversation as we go through. So here, if I go back through and I'm kind of explaining what's going on first, is that we are looking at governmental accounting financial statements. And I want to bring us back to what we had looked at previously. And just to refresh our memory, that the information for governmental accounts are listed in two different ways. They're listed under the government-wide, and these are the government-wide financial, here, let me see, under government-wide and the government-wide financial statements, and then they're kind of rephrased under funds. Now, they're not completely, I guess I'd say there are some things that are covered in one and not covered in the other. You can see discrete component units are covered under government-wide, but not under the fund accounting. And fiduciary is covered under the fund accounting, but not the government-wide. So there are some holes. They're not a complete coverage of all the information, but between the two, you cover all the information, and some of it is stated and some of it is duplicated but stated in different ways. This government-wide is accrual accounting, same with the proprietary and fiduciary. So this top part is all accrual, and these two right-hand ones are accrual, but it's the governmental funds that are the modified accrual. And you notice that we've got a number of different types of statements. It'd be nice if they harmonize them to where they all have the same name, but of course they don't. So you see a lot of statement of net position, net position, net position. That's a balance sheet basically, but they do call it a balance sheet under governmental funds. Statement of activity is sort of an income statement. On the other ones, they call them the change in the fund balance, or the change in the net position, change in the net position. So those are activities. And then only one of these has a statement of cash flows, and that's the proprietary funds. Now, we're not going to get into those. We're basically going to focus a little bit on government-wide and then spend most of our time talking about governmental general funds and major funds and what are the accounting for those. So let's go ahead and take a look at some of that information. If we're looking at the outline, reporting expenses of revenues at the government-wide, that's here at the top. Display the net expense or revenue of each function or program. Functions and programs are fairly interchangeable. Let me go ahead and take a look at this here. This is sort of an example of, you can see here's function and programs, here's program revenues. Now, functions are basically things that deal with major services or something that has been legally defined as a responsibility of government. And so we call those functions. And in fact, most general purpose governments report according to function. Other types of governments may have programs in it. And it's not to say that you can't have one or the other, but yeah, generally general purpose report by function, like the police department, the fire department, that sort of thing. Programs are organized around purpose or objectives. These are more specific. So if you have special type of a governmental entity, they may have more program level activities, whereas a general purpose government has more functional activities. Now, do notice though, we list expenses first, and then we have three different types of revenue, and then we have net revenue, net expense or revenue. So basically, what we're saying here, the important thing is, what does it require? What are the expenses required for us to provide the service, to provide the function? So we state that up front. Basically, we're saying we know we have to spend this money to provide the service. Now, do we make enough through charging for the services or contributions to be able to cover our expenses? And so you'll see that a lot of times, let's see if I have it here. Here's the one from the city of Denver, city and county of Denver. Again, you see expenses, charges for services, operating grants, capital grants, and listed the same way. But you notice that almost all of these are negative, meaning the revenues do not cover the expenses, only in one small situation, community development. So maybe that's theater, I don't know, or maybe those are, community college or something like that. So maybe they cover their contributions, but most everything else, public safety, police department, public works, all those other things, they don't cover it. Now, that's not to say they go unfunded or they have shortfalls. Let's go back and take a look here. That's because those are the services, those are the charges for services, operating grants, and capital grants that are directly related to the function. You can see that there's a whole category of general revenues that will cover the shortfall of any individual function, or hopefully the general revenues will cover the shortfall of any of the individual functions or programs, or at least will get you close, right? And if we go back and look at Denver, actually I don't have the bottom part. Let's see the bottom part here. It says, it looks like the bottom part for Denver shows that there is still excess of expenses over revenues, and that it's a relatively small shortfall. But that is typically the case, and that's why cities and counties and states have to do various types of additional taxes, or they issue debt to cover that. And so some years they may cover it and some they won't. But the important part to focus on is that we state the expenses first, because we know that's what we need to spend to provide the services, and then can we cover it through specific charges according to function or general revenue. And you can see most of general revenue is taxes. There are some other amounts, investment earnings and whatnot, but most of general revenue is taxes. So do taxes cover, in addition to charges and grants and contributions, does it cover all the services for government? Now, what's the difference between an operating grant and a capital grant? That can be something like, there may be some grants and contributions, maybe from the federal level or from other parts of government, that are there specifically restricted to providing like day-to-day operations, like paying for salaries for firemen. Whereas a capital grant might be funds or resources specifically for maintaining assets. So whereas the operating grant might be for salaries for firemen, the capital grant might be money or funds to buy new fire engines, right? That sort of thing. So you would have both of these kind of separate, and depending upon the type of function, they may be bigger or smaller, and the same with the charge for services. So this is remember, we're still looking at government-wide. This is still a government-wide sheet right here. When we're reporting expenses, so if we continue looking down the Sorry, I'm starting to get a little bit stuffed in the nose. When reporting expenses, there are two types: direct and indirect. Direct expenses get attached directly to their function. Now you notice we have here, this is an indirect expense, and so it's listed separately, meaning perhaps long-term debt is something that the city or the county has, and it may be used for different function, but it's not used directly for any of those. It may be just there to cover shortfalls, right? So if an expense can be considered indirect, it may get its separate line item here, or if it's big enough, or it might be aggregated as far as overall other interest. Now the question is, what is depreciation? From a government-wide level, again, remember, from a government-wide level, depreciation is a direct expense. That's one of the items here that we fill in, right? Is a direct expense. And that's because depreciation is a cost allocation for a long-term asset. Assets, for the most part, unless otherwise specified, assets for the most part are tied to certain functions. Well, we just talked about fire trucks. Well, depreciation on fire trucks would be, you would imagine that we would need to put that in the fire function or the fire department function. So typically, unless otherwise specified, depreciation is a direct expense because the underlying asset for which we're depreciation is typically tied to some function or program. When we're reporting revenues, and now we're talking about these guys up here, program revenues come in three different types: charge for services. That could be things like licenses. They could be fees. They could. We're going to talk a little bit more. There's another part where we talk about the different types of charge for services. We do mention here that special assessments are also kind of a charge for service. Grants, I've already kind of mentioned operating grants and capital grants and how they work out. They're just restricted for their type of use. If you get a grant and contribution restricted for operating costs, that's one type. One is another one's for grant. We have one more fill in the blank here, and that's the word unrestricted. You can see that here. Revenues and general revenues, I have italicized unrestricted. That goes into the outline here. And the purpose of this is to say, well, you could have all sorts of other type of general revenue, multi-purpose grants, endowment earnings, permanent fund investments. So I could throw anything at you, or you could look at any particular thing, and you may wonder, does it go into the function as a direct item, or does it go into general? And the way you know is you just say, you look for the word unrestricted or restricted or special purpose. If it says the word unrestricted, then those revenues go into general revenues. And you can see here, we've got grant and contributions not restricted to a particular program. That's specifically what we're talking about there. Now, if you have another type of grant and contribution that is restricted to a program, then it needs to be included in one of these columns for the function or program that it's restricted to. The last part here is what are some of these other items that we have down here? Well, you can see we've got special item, extraordinary item, and transfers. So let's just take a quick look at those. A special item is something that's within management's control, but it's sort of unusual. In fact, the definition is it's unusual or infrequent. And I've underlined the word or because as opposed to a special item, an extraordinary item is not within management's control. It's unusual and infrequent. That's the definition. It has to be both. And you can see here, well, we've got quite the extraordinary item, loss due to volcanic eruption. It's kind of a little bit weird that we just have this one line. Volcanic eruption, it caused this much damage. So the other thing about the extraordinary item that I'll point out is that we used to have this in GAAP accounting. We used to have the term and the account called extraordinary items that would be included on the income statement, but we no longer have it because companies abuse this particular account and they they were basically stuffing all of their things that they didn't want people to look at too closely into extraordinary items. And the definition was that an extraordinary item had to be unusual and infrequent. Well, it came to be where companies would have the same item in the extraordinary item every year. So it stopped becoming unusual and it stopped becoming infrequent, and they were just using it as a way to hide some like if they had store closures or some sort of inventory loss, they'd say, "Oh, that's an extraordinary item." No, they were misusing it, and we couldn't get them to stop, so we just did away with it. We did away with it. But extraordinary item lives on under governmental accounting standards. And so it's just kind of interesting to see that the extraordinary item is still here. And I guess they're hoping that governmental accountants will not misuse it. I guess it's we'll see. The last part is transfers. Whenever we're talking about a transfer, you have to also remember that a transfer that goes under the general revenues area means that there is no exchange or there's no reciprocal service. In other words, if some other part of the government transfers in funds, they're not expecting a service in return. Because if they did provide funds, provide resources, and we're expecting some sort of service, well, then that makes it a function, right? Functions are specifically, we charge for the service. So a transfer here it's just sort of a one-way transfer. There's no reciprocal return of a service or something else like that. So just make sure you understand that definition. Okay, so I think I picked up on Learning Objective 2, and so I'm going to end this sort of re-recording of Learning Objective 1. Hopefully I will splice it together correctly. If it's a little bit awkward, kind of going from one to the other, I apologize, but hopefully in total you will see all of the learning objectives sort of in their proper order. Okay, thank you, and in just a second you'll have Learning Objective 2 pop up. And so, thanks, Caleb. So I just started recording. Unfortunately, I didn't catch the first learning objective. Probably what I'll do is when we sign off here, I'll just include it at the end for those who are not in the Zoom channel tonight and just are going to watch it. I will kind of follow up at the end after everyone signed off and record the rest of it. Okay. So the second one is we're going to, just to remind ourselves, is that that first thing that we were looking at was some of these government-wide. Now we're going to turn around and look at the governmental fund reporting. So we're going to look at the governmental fund and take a look at how that is different. And so remember that the primary, or here, let me bring that up again. The primary fund within the governmental funds is always going to be the general fund. There's one and only one general fund, and that's where you run most of your government activities, or you report most of your government activities. Let me see if I've got another one here. So here is a general. Here is another example of, without numbers specifically. Here is a general fund, and then major fund 2, major fund 3, other governmental funds. And so let's just talk a little bit about the types of funds. There's one and only one general fund. Major funds, if you remember from the previous recording, is that you are required to report other large funds, no matter what type of fund they are. But there's kind of a two-step criteria. And if you remember, it's kind of a complicated. You have to pass a 10% threshold and a 5% threshold, and then you can report it as a major fund. And so not many places have, they may have a major fund, one or two major funds, but not more. Sort of aggregated in other governmental funds. What are some of the other funds? Special revenue fund. That's when you get contributions or there's some sort of revenue by, that's, a tax collected by and specified by law for a certain purpose. You wouldn't put that in the general revenue or the general fund. You'd segregate it out and track it in a special revenue fund. Debt service funds. This is part of the. Here, I'll give you a second to look at and find the kind of fill in the blanks. So here we're talking about type of fund, and I'm saying a debt service fund is to separate out the principal and interest payments for debt servicing. Typically, you want to be able to have one spot to where you can go and see that very quickly for a government. And so even though it's aggregated here in these other governmental funds, you would be able to look down into the notes or a separate chart or a separate disclosure that it'll break out the other governmental funds, and you can see how much has the government borrowed, what are its principal and interest payments. Capital projects funds. For a normal general purpose government, well, there's a lot of capital projects. There is roads, there's bridges, there's streetlights, there's parking garages, there's buildings that they have to maintain. So there's always different types of capital projects. So there's probably a series of these funds, capital projects funds, that are kind of listed in there. And then we have permanent funds. Permanent funds are backed by an endowment. Remember, an endowment is where some sort of contribution is made to where a principal amount is established, and the principal is not allowed to be used. The principal amount is to be preserved, but then you invest that principal, it's earning interest, and what you do is you use the interest earnings off of the principal as the sort of revenue stream. And, we've all heard of endowments for the university, right? Some universities have ginormous endowments. I don't know what how big the one is here, but I think it's run by Steve Meeker. That's why he's such I think a big deal, is because he's in charge of the university endowment. That's why you always see him at big events. The Harvard endowment, I think, is, billions and whatnot. So anyway, that's another type of fund, permanent fund. But because none of them rise to the level of a major fund, they all kind of get aggregated here in the other funds. For the general fund and other governmental fund balance sheet, we use modified accrual. Just sort of a reminder of what modified accrual is that, I don't think we're here yet, is that modified accrual is focused on current resources and current obligations. It's only saying, do we have enough now to cover the services that we need to provide? Do we have enough cash now to provide the services we are providing right now? And that kind of creates a fund balance. Each of these funds will have a fund balance, and the fund balance is you add assets plus deferred outflows. You take those two combined, and you subtract out liabilities and deferred inflows. Now, I usually get questions about what is a deferred outflow and a deferred inflow. They're relatively rare. I think when we have a couple here, I will point them out. But you have to think about that it's basically on, the deferred outflow. These are some assets that are present but are not accessible, and therefore they don't quite meet the definition of an asset. And same with the deferred inflows. That's some sort of liability, but in other words, it's some sort of obligation, but it doesn't meet the level of a liability. Sometimes deferred outflows are a little bit easier to comprehend. Whenever we use the word deferred, remember this is saying for a upcoming time period. So if modified accrual is only focused on this time period, you could say that an asset is something that's present and available for this time period, and then there could be assets that are present but they're not available, In other words, it has to be both, right? It has to be present and available, but it's present. We have assets, they're present, but they're not available until a future time period, right? So it's sitting there, and we would say, okay, we would qualify these as two different things. And an inflow might be something like that we should have some cash coming in, but it's not accessible until a future time period. And so when we can see that the difference would be, okay, they are assets and they are liabilities, but the main difference is whether or not they're available and present for this time period versus whether they're here but not available because they've already been assigned usage in a different time period. So, like I said, they're not as easy to conceptualize, but when we come across, I think we have a couple in here in the notes that are in the outline that I'll point out when we get to them. But the fund balance is the assets plus deferred outflows minus the combination of liabilities plus deferred inflows. So long-term assets do not provide current resources, and therefore they're not covered. And long-term liabilities do not consume current resources, and they're not reported under modified accrual either. And that is one of the other items here. That's the neither. If we continue on here, we've got the general fund and other government fund. So we've got this long name for basically the income statement: revenues, expenditures, and changes in fund balance. So revenues are increases in fund resources, and where do we get those? Taxes, fines, license permits, and that sort of thing. Expenditures. So let's have a definition of what is an expenditure versus what is an expense. So you can remember from GAAP accounting, the matching principle, that an expense is specifically tied to a revenue. In other words, an expense is something that is used up to generate a revenue. And the most obvious example that we have is COGS. COGS is an expense. COGS is an inventory expense. In other words, in order to generate sales revenue by selling inventory, we have a COGS expense saying, okay, yes, the revenue is what the customer gave us. That's the cash they gave us. What did we give the customer? What did we use to be able to have, receive that cash? Well, we gave them inventory. So we used up inventory. And that whole concept of using inventory is called COGS, and it's an inventory expense. So you can see in GAAP, expenses are specifically tied to revenues by definition. An expense is something that is consumed to generate revenue. Whereas an expenditure, you can see here, an expenditure represents the cost to purchase a good or service, something quite different. So if we have to provide some good or service by law, the amount that we spend in acquiring it and making it available to the public is an expenditure. And that's not to say that some things aren't expenses also. Sometimes they can be both, and I've listed here. Sometimes, payroll, utilities, or travel can be both an expenditure and an expense because they're used up and they are purchasing a good or service. But just be careful of your definition. I will definitely... That'll be one of the ones I definitely test. What is the difference between an expenditure and expense? The depreciation expense is never recorded in governmental funds. So we made a point of talking earlier about depreciation is a direct expense, but that was in the government-wide, right? The government-wide. Now, when we're talking about fund accounting, these are all funds here, right? General fund, major fund. Depreciation expense is never recorded in governmental fund as it's an allocation of cost for a long-term asset. And remember, fund accounting is on modified accrual, so you won't see depreciation because it is not a current. Remember, we're talking about current resources or current liabilities. Remember, depreciation is more of a bookkeeping mechanism. It's just, we paid for the asset. Now, how are we apportioning the expense over time. We're not actually, think of it, it's a non-cash expense. So therefore, it's not a use of a current resource. However, the purchase of the equipment would be expenditure because that is using current resources to buy equipment. Other funding sources, so we've got down here other funding sources. We've got interfund transfers, and we got debt issuance and that sort of thing. And those can be here. So we've got fund balance beginning and ending, and we have these things. So the structure and the characteristic of the governmental funds, we talked in brief previously. Just make sure that you're clear that, because unfortunately they have a bunch, it's like, do you remember how, I guess, confusing it was the first time you heard someone talk about depreciation expense versus accumulated depreciation, right? That was, well, why do they have to be so close in the terminology, and yet they're very different? Or sales revenue and unearned revenue. Sales revenue is a revenue, unearned revenue is a liability, right? So this is another one of those situations where you've got the word governmental in a lot of places, and here we're talking about these are the governmental funds, but that's going to be different from, if we go back to here, this is going to be different. So these are the governmental funds, and we're using the word funds, versus the government-wide statements overall. So here we are using governmental activities under the government-wide. Here we have governmental funds under the funds, the fund financial statements. So just make sure that you're paying attention when we're talking about one versus the other. One of the major things, now we're on to 3-3. One of the major things about governmental statements, and this may seem initially kind of a little bit extreme, is that we basically find a way to insert the budget into the financial statements, because what we want to see is what was the budget and what was the actual, and we want to see variances. And, when you covered managerial accounting, you learned about variances. You learned about the budgeting process and variances from a corporate point of view. But, that was all internal decision making, right? Corporations never turn over their budget and their variances to the public for them to see. But we're not talking about a corporation. We're not talking about for-profit. We're talking about a governmental and a nonprofit. So budgeting is a very important part of the whole, taxing and, receiving revenues or resources to be able to use for public services. And it starts with, the budget process. It starts with, the lowest type of individual governmental units will come up with projections, and then they will sort of keep pushing those up the ladder to where they start to aggregate them. In other words, each police station may have their own projection, and then the whole police department as a whole would say, well, here's all of the police station projections together along with police headquarters, and then you submit that up to the city, and the city says, well, here's the police and the fire and the public works projections, and you put them all together, and you get a budget projection. And of course, I don't know if you've ever attended any of those, but city councils and whatnot, you can go and attend hearings. People can talk from the public, make suggestions, say rude things, all sorts of stuff. But there's going to be an initial budget, and then there's going to be a final budget that will be approved. And the difference between a corporation making a budget and then tracking their actuals versus their budget, which are variances, is that is just internal projections. Whereas the governmental budget is sort of done all in the public eye. It's done with public input. It's done so the public can see where the money is going. And specifically, it is legally adopted and binding. Meaning once the budget is accepted, governmental employees are supposed to work towards that budget. And so it's very important for, before the budget gets done, that everyone gets on board. And, you've heard in times past where even like the federal government, when they're fighting, sometimes they go right up to the wire and sometimes over to where they don't approve the budget as a way of kind of holding each other hostage. And, there's been a couple of times in the recent past where the federal government has shut down. It's because we got up to the got up to the deadline for the budget. No budget was passed, and therefore, there's no funding, and so things have to stop until. And once things like that happen, then people start to get upset. People aren't. Government employees aren't getting paid, and that's never good for reelection. So usually, pretty soon after that, things get solved. Or I wouldn't say solved. Things get compromised. People start to work on it. So if we take a look at, what do I got here? So this is a situation where we're working the budget amounts into the financial statements. Now, this wouldn't be necessarily, I guess there's a lot of flexibility with governmental statements, in that you'd have to have, your balance sheet or your statement of net position and your statement of activities. And this could be included with those, or it could be its own separate statement, or it could be some sort of disclosure in the notes. Depending upon how big and complex or how important it is to the local citizenry, it may be any of those three, but it'll look something like this. So you can see here we're looking at a general fund and then a major special revenue fund. And in fact, those are the two that are required to have budgets. Any special revenue fund, any major special revenue fund, and the general fund have to show budget amounts. And then, so here you have the original budget, the final budget. These are the actuals, and then the variance, the difference between the actual and the final budget amount. And let's take a look at what we're looking at here. Budgetary accounts required by state law to be integrated into the general ledger and the financial statements. Estimated revenues. Okay, so what is a budgetary amount? So when we're talking about revenues, we're talking about budgetary revenues versus actual revenues, and how are we going to track these according to a T account? We have looked at this in the past, and I don't have a diagram or something here to kind of draw it out, but I'm going to ask you to remember back when you did cost accounting or managerial accounting. Remember when you were trying to determine direct materials, direct labor, and manufacturing overhead, if you remember that. Now, if you went through, and of course I don't know your particular cost accounting course, but typically what is taught is that because direct labor and direct materials can be known in real time, you can put those costs directly, you can track those costs directly and, find out what it is for your COGS. But unfortunately, because manufacturing and overhead, a lot of those things, perhaps it's insurance at the end of the year, or perhaps it's some sort of utilities that you don't know until after the period, that manufacturing overhead has to be estimated, right? And that's where you have the predetermined overhead rate to estimate manufacturing overhead. Is any of this sounding familiar? And so what you do is you calculate manufacturing overhead applied. And that is the amount that you use plus direct labor plus direct materials. You use those three numbers as the numbers that you plug in for your COGS until you get the actual manufacturing overhead. And on a T account, manufacturing overhead applied would be a credit. The actual manufacturing overhead would be a debit. And the difference between the two would be the over or under applied manufacturing overhead. Now, hopefully, I'm pretty sure you must remember the concept of over versus under applied. And so the same thing is happening here, is that we may have a revenue account, and on one side we have our estimate, just like we have manufacturing overhead applied. Well, because revenue is a credit, our estimate of revenue is going to be a debit. And so that's what we're talking about here as far as budgetary accounts are typically recorded as the opposite of their statement accounts, because it's the difference that says whether we're over or under our budget. So estimated revenues, which is the budgetary concept, is recorded as a debit, and the revenues are recorded as a credit. Appropriations are the same idea as an expenditure. So an expenditure is the actual financial statement item, revenues minus expenditures. And so the budgetary version of an expenditure is an appropriation. And then we have one last thing. So the three things we're going to focus on are estimated revenues, appropriations, and encumbrances. And an encumbrance is slightly different in that it is a estimated or expected expenditure, so that they are similar to budgetary items, and they'll have the normal balance of a expenditure. In other words, a debit. So obviously you don't see those amounts here because all we see is the budgeted, the revenues. This is going to be the revenue minus the expenditures. And so all we see is the net version here. When we get to the last learning objective and we actually look at a couple of journal entries, I will point out what we're doing there. But hopefully you remember your manufacturing overhead applied, because we're basically using that same concept. And as for those of you who have taken a couple of classes with me, you know that I'm very big on showing where accounting reuses a very similar concept but in a different area, because it's not to say that accountants are not creative. It's just that they have certain sort of mechanisms that they like to go to and say, okay, here's another situation to where we can use the same mechanism in a different context. And so you will have learned this process before while doing cost accounting. Now we're just applying the same concept when we're talking about budgets or governmental budgets. Sorry, I was getting a little dry mouth there. I need to take a quick sip. Okay, so GASB requires that at a minimum the original and final budgets, which is what we have here, the actual inflows, outflows, or balances, and their variance, which is what we show here. Let's take a look at, so this is the outline of the budgetary accounts. So you can see here, the normal operating account for revenue is a credit. How we track it is a estimated revenue of a debit. And what we're trying to say is, if we have a budgetary account where we're trying to say, did we reach our estimated revenues? Well, we're going to enter the estimated revenues as a total number. Let's say we want to have revenues of $1 million, and then on the credit side, we're going to start entering revenues as we receive them over the year. And obviously, once we reach $1 million, that means that the account will have zeroed out, meaning we would have reached our goal. And then anything over that on the credit side, it means that we have overachieved, or we received more revenues than our estimate. And same with appropriations and expenditures. We want to say this is the amount of expenditures that we believe that we'll need. And when we use the word appropriation, remember, appropriation is part of the budgetary process, to where we say, okay, for the next year, we believe the amount of money that we need to run the police department is going to be $2 million. And so we would track that as a credit. Think of expenditures as an expense. And so those would be normally listed as a debit. And so as we go along, and we, every month we add in the police the police actual payroll or the police actual expenditures. Once we get to where expenditures match appropriations, we've basically used up all of the funding that we have set aside for the police. So that's what happens when you get to zero on that situation. And anything over that is meaning you have more, you're spending more than you had appropriated for whatever function or program. Continue on with 3.4. And like I say, some of these will be a little bit clearer when we actually get into some of the journal entries, which is not quite yet, but that was a look at it right there. I'll just pause for a second and ask, do I have any questions right now? Something I always know governmental accounting, governmental and nonprofit accounting is very strange and foreign, and sometimes it's hard to get head around the concepts. Just remember, this is your first exposure to it, so it is going to seem strange, but more than trying to make you, I'm not trying to make you a governmental accountant or a nonprofit accountant. I'm basically just trying to expose you for the first time so that if you go on to study for the CPA exam, you'll have at least heard most of these concepts, and you can kind of then solidify them as you study. Or if you are going on to work for a nonprofit or for a governmental agency, you will have heard these concepts, and you will have basically understood how they differ from normal GAAP accounting in general, so that you can, it's basically hit the ground running. Obviously I'm testing you on a lot of this stuff. I don't expect any of you to feel comfortable with it right off the bat. So, just FYI, I understand that it's a little bit kind of confusing. But having said that, any questions at this point? Okay. So let's go through and talk about a couple of terms and classifications for the budget. And here we've got, I have a couple of them: appropriation and expenditures. When it says, when liabilities authorized by appropriation have been incurred, the appropriation is said to be expended. That means an appropriation is we've set aside a certain amount of money to run the police department. And as liabilities, payroll comes in every month. Each time payroll comes in, it sort of uses up a little bit of the appropriation. In other words, it expends part of the appropriation. And if you remember, that's one of the things I said that GAAP accounting does not do well, is it does not earmark funds for a specific purpose. But here you can see in governmental accounting, that's exactly what they do. Appropriations are basically setting aside this amount of resources and saying, these resources are for this specific reason. And in fact, we're going to track it that way. We're going to track our use of it as we go along. So, and that's not what we do. In other words, we don't set aside in GAAP accounting, you don't have any methodology to set aside, well, I only want to spend this much on interest expense, and so therefore I'm going to appropriate a certain amount for interest expense. You just pay it as you go along, and whatever the amount is the amount, and you just roll that in to the income statement and as an offset to revenue and say, okay, extra interest expense reduced net income. But that's not how we track it here in governmental. So when we look at the terminology sheet here, some of this stuff we've already done, but this is just collecting all the terminology in one spot. Appropriation, a legal authorization to expend cash or other resources for goods, services for specified purposes. Expenditures are classified by the following categories. They're always classified under the fund format. This is the basic accounting entity for governmental reporting, or at least the fund reporting. And then it could be, according to any of these other ones, you could have expenditures listed by function, by organizational unit, by activity, and then you have a couple of other kind of less common ones, character, object, that sort of thing. I'm not so worried about the character and object, although, who knows, maybe I'll include one of those as a question, but I do want you to understand that you can classify expenditures by fund, function, organizational unit, or activity. The classification of estimated revenues. Government may only raise revenues from sources available to it by law. So that's important. Government can't just go anywhere and get resources. Like a corporation can go anywhere and take out a loan. It can issue bonds. It can sell stock. Government can only get resources by those that it's been allowed to by law, that it's available to it by law. So they really have a few. Now, I say that, but it's not quite as restrictive as you think. So if the laws of the state or the laws of the city allow them to levy a tax, the people who are in the jurisdiction don't, it's compulsory, right? They're not allowed to say, no, I don't want to pay this tax. Well, they can opt to do that, but then they go to jail. So whereas a corporation can't compel shareholders to buy their stock. Well, when a government levies a tax, they can compel citizens to pay the tax. It's compulsory. So I guess it's a different form of generating revenues or resources. What are the main types of revenues? Well, taxes is the big one, right? Taxes on all sorts of things. It's the largest portion of revenue for all levels of government. Now, remember, under modified accrual, revenue is recognized when it's measurable and available. In other words, if you haven't collected the tax yet, it's not revenue. Not until you've collected it, and you've actually gotten it, can it be considered revenue. And so GASB, and I think I pointed this out in one of the previous chapter, GASB has a rule specifically for property taxes, because that, in fact, is a place where a lot of local governments get their funding, is by levying a property tax. And they say, okay, you can count as being quote unquote available if you collect property taxes up through 60 days after the end of whatever the fiscal period is. So after the end of the fiscal year. So it doesn't have to actually be within the fiscal year, but it has to be collected and available up to 60 days. Now, there's all sorts of other taxes out there, and there's no GASB specific rules for all those others. And so state and local governments can decide what is defined as available for those other ones. But because GASB has a rule specifically for property taxes, a lot of times state and local governments just go ahead and accept 60 as kind of the norm, even though it's not required for anything except for property taxes. And so 60 days after the end of the fiscal period is the definition of available, is a common one, but it's not required for anything except for property taxes. If taxes are not expected to be available for use in the current period, they should be recorded as a deferred inflow of resources, right? So a deferred inflow of resources, if you remember looking back at the definition of that, if I go back here and I look at, let's see, where is it? Remember, our fund balance is assets plus deferred outflows minus liabilities plus deferred inflows. So here we've got a definition of a deferred inflow, meaning we'll collect the cash, but because it's outside the collection window, we cannot consider this as part of the assets of it, the resources available for the current period. And that's all comes down to just because of the definition of when it's available. Property taxes, we call them ad valorem. That just means based upon value. We do property taxes through a property assessment. Now, the textbook has a lot more detail about property assessment and one or two different versions of how property assessment can happen. I'm not so interested that you know exactly how property gets assessed at this point in time. I just want you to know that property taxes are determined by a property assessment. Some property is not taxable, and I was going to say according to your corporate income tax class, but so this category of assets, as far from a tax point of view, are considered. You hear the phrase real property and personal property. And the definition of real property, you have to think about real as in the phrasing of real estate. Real property is land. Um, and personal property are any significant assets that are movable. So you can think about plant, property, and equipment. So plant and property are kind of real, what we call real property, and equipment or other things that are movable or not affixed to the surface or affixed to the ground uh, is considered personal property, even though we're talking about equipment and that sort of thing, or trucks or stuff. So if you ever see the definition of something that says real property, they don't mean versus fake property. They're using a specific tax phrase. Real property is anything that is immovable, affixed, and is part of the landscape, which would be land and buildings, and then personal property is something that is movable. I always kind of get a bit of a giggle here. A penalty is a legally mandated addition to a tax. In other words, government doesn't have the option to not assess a penalty. A penalty is automatically required as soon as a tax becomes delinquent. Other types of taxes: sales, income, gross receipts. There's a lot of states have a liquor tax or a cigarette tax. What we call those in the business, we call those sin taxes, SIN. They're taxes on sinful behavior. Well, you probably don't see that around here, but those are very common phrases down in the Bible Belt. So, sin taxes. Just like I don't think you have dry counties here, but down in the South you have dry counties, which is kind of funny because all that means is you end up having liquor stores on the county line. Just like you have fireworks stands right on the state line here because maybe one state doesn't allow it and the other state does. Same sort of thinking. License, permits, fees to obtain various rights, privileges. Okay. So these are different ways. These are different sources of revenues. Again, for the government, one is taxes. The second one is special assessment. We talked about special assessment. This is where whereas a property tax is levied on everyone within the jurisdiction, a special assessment is sort of like a property tax, but just on a narrower group of people based upon whatever the situation is. And we use the idea of snow removal on a private private road as a special assessment. Selling of licenses and permits. A lot of times there are licenses. It used to be the joke that in order to have a hairdresser had more extensive requirements to open a store because of the licensing and the certification than a lot of other activities. So sometimes to open and run a particular type of business, you have to purchase a business license. A lot of times when people hold events on public property, they hold a rally or something like that, they've got to pay some sort of fee to hold the event, because that's supposed to offset the increased police presence or or the cleanup that's necessary. Building permits, vehicle licenses, these are all ways that governments can generate revenue. Intergovernmental revenue, this is when one part of the government transfers some. Now, just remember, anytime you have an intergovernmental exchange, it should be considered what we call a I don't want to say intergovernmental transfer. We wouldn't consider non-exchange, because the whole idea is one part of the government gives it to another part without any expectations of services being rendered for those funds. If one part of the government is giving funds to another part and expects services in return, well, then that becomes a function. and then you track it according to the expenses minus the service revenue. So an intergovernmental transfer means it's only one way. There is no expectation of any services being provided. Other types of services: court costs, library fees, parking meters. There's all sorts of little ways for the government to be able to get money out of you, believe it or not. Fines and forfeitures, miscellaneous revenues. You can see this here in the document. There's other financing sources and uses. Well, we've used the phrasing use and source when we talked about the cash flow statement, right? We said, is something a use of cash or is something a source of cash? We've used that phrasing before, just so realize a source is an increase in resources and a use is a decrease in resources. Okay, so let's take a look at a couple of journal entries. I'm not going to go through all the ones in the book, but I'm going to go through, I think, 3 of them that I think are important. So let's take a look at some of these journal entries. So this is the first one. Now, this is split up into two different ones, but we want to make sure that we understand what's going on. So here, they've got a subledger, and they're not actually lined up that correctly. But I think this is the debits and credits for the general ledger. There are no debits here in the subledger for the second part, and these are credits. So in other words, just think about these two numbers as shifting over under the debits and credits here. I think it'd be good. So here in the subsidiary ledger, you've got these numbers which add up to the estimated revenues, right? In the estimated revenues ledger, you have taxes. This is what you think that you're going to be able to get, right? This is your budgetary process. You have estimated revenues of taxes, intergovernmental revenues, and licenses and permits. Now remember, a revenue is a credit, but our estimate of it is the opposite. So when we add these up, we get the estimated revenue, and that's the amount in the budgetary fund balance. And then we have the same thing, except now we're looking at expenditures. And so here is a bunch of expenditures. Now, expenditures and expenses just are debits, but our estimation of them are credits. And you can see here that the 1,000,015 and the 212,000 add up to the 1.362. And you notice the phrase is, even up over here, we use the word estimated revenues, but we don't use the phrase estimated expenditures. What do we use? We use the word appropriation. So an appropriation is an estimated expenditure. And we use the word appropriation is because, yes, we could use the phrase estimated expenditure, and that's not necessarily wrong, but the idea of appropriation is a little bit stronger, because we're saying if this is the estimate of what it takes to run the police department, well, we not only need to know what the estimate is, we need to actually go and appropriate that money so that we can fund the police department. So appropriation is sort of a sense of, here's the estimate, and in fact, we're going to take it one step further and appropriate those funds to get things going. Here's the estimate of other financing resources, which is the interfund transfers. So you add these two up and the budgetary fund balance here. Now imagine if we put both of these together, where we had the estimated revenues offset by the estimated appropriations, and if we had the estimated revenues offset by the estimated appropriations and other things, we'd have a fund balance of, I think it's like 300 and something thousand. I think I wrote the number down here somewhere. 359,000, and that would be what we would consider to be in our budgetary fund balance. In other words, that would be how we populate. Those would be the journal entries that we would use to populate the general ledger with our budget, right? So what happens once we've set up the budget? So this would be the budget for the revenues and appropriations. Let's take a look at the next one. Now, it is very common for you to want to know, okay, we set up in this sheet, I can make it a little bigger. In this sheet, we've estimated the amount of revenues, but they don't come in all at once, right? Revenues, some of them come in chunks, some of them come in as sort of amounts over time. And so you might want to say, okay, this was my budget estimate as far as revenues. You can see this is the revenue ledger. And you want to say my budget estimate was, we're supposed to have estimated revenues of 195,000. Now, again, remember, the estimated revenues are a debit, and revenues, you can see here, revenues are a credit. So if we're thinking about this as a T account, we're saying, okay, I need to make 195,000. So as I actually receive revenues, I'm going to have a balance in this budgetary account saying, on the debit side I have 195,000, on the credit side I have 13,000. So what's the balance? 181,000. And what does that balance mean? That means I still have, of the 195,000, I still have to collect 181,000 more, 181,800. And so the budgetary ledger is just showing me at any point in time, I can see what, I don't want to call it my shortfall, but how much more do I have to collect before I reach my budget estimate? And of course, you would hope that your credits end up being more than your debits, right? That you collect more revenues than you estimated. That's always a good thing, but it doesn't necessarily have to be that. Let's take a look at encumbrances. So this one, let's see, let me just check. Oh, that was the other thing. So this is the sort of the last one here. This is a little bit, it's not too hard to follow, but it may seem a little strange at the beginning. And I don't know how familiar you are. I mean, you're probably very familiar at looking at T accounts, but you may not be as familiar when you're looking at it in a ledger version. So this is a ledger, obviously, and so they list the debits and credits side by side, but they list it under different categories. So they do list it by date. Here we've got the encumbrances, here we've got the expenditures, and here we've got appropriations, right? So remember that appropriations are our initial estimate of how much we want to expend. And so at some basic level, we're looking at the difference between appropriations and expenditures. So what is an encumbrance? Remember, several times I've said, wouldn't there be a nice way to say, I've set aside this amount of money to do a specific purpose? Well, that's what an encumbrance is. So here we have the budget entry for the appropriations, right? We've basically said, for whatever department that we're looking at, whether it's fire or police or whatever, we said we believe it's going to take us 1.15 million to run them this year or this month or whatever the time frame is. And so we've appropriated that amount of money. We've set aside. Now, remember, expenses or expenditures are debits. Therefore, my budgetary version of it, the appropriation, is a credit. And so what I'm going to be doing is I'm going to be entering in expenditures as they are realized, as we actually have expenditures, and match them off against appropriations. And the available balance is going to say, I have appropriated this amount. This is how much left I have to spend on this particular governmental unit. So the first line is just to set aside, this is how much I've appropriated. Now, you will see that the next time that something comes in is a purchase order. The purchase order is there to say, well, in the scheme of things, we don't want to wait until, from the governmental point of view, we don't want to wait until we get the invoice and pay the invoice before we actually apply it against appropriations. As soon as we know that we're probably going to have to spend some money of the appropriations, we want to go ahead and set that money aside, and so that it can't be used for something else. And that's what an encumbrance is. We've encumbered the appropriation, meaning we've set it aside and prevented it from being used for something else. So here we've got a purchase order. Now, in the grand scheme of things, will purchase orders actually be realized to the exact dollar amount? No. But at least you might have an idea, okay, this is, we are sending out a purchase order to a vendor. We want them to do something for us or provide us goods or services. And we've authorized a certain amount here for the purchase order. And so what we've done is this encumbrance is going to offset the appropriation. You can see the debit of the encumbrance offsets the credit. So even though we had appropriated 1.15 million, we're going to set aside, we're going to encumber 38,000 right off the bat and say, I believe we're going to use that that amount here in the near future, so don't let that amount of money go for anything else. So what is available? Well, it's the 1.15 minus the 38,000, which we've encumbered with this particular purchase order. Now, what ends up happening is, okay, remember the purchase order is being issued from the governmental unit. They don't know they have an idea, ballpark of what the amount should be, but perhaps they're ordering something and the price has changed, or maybe the service fee has changed, maybe it's up or down. But in any case, the vendor comes back to us and says, they said this is the invoice for your purchase order, and it ends up in this case being a little bit less than what we had set aside, and says, okay, invoice is approved for payment. So against this purchase order, against this 38,000 that we set aside, that we encumbered, we have now approved for payment 35,000. And so it ends up, for whatever reason, that by the time that we end up paying it, that the actual dollar amount, maybe there's a late fee or maybe there's some transaction fee, that the actual amount that we spend is a little bit different from the invoice, and that's common. And so that will further reduce the available balance. Now you may wonder, well, if I initially set aside 38,000 and I only used 35,000, why don't I return that 3,000 to the appropriations to be able to be used for something else? Well, there could be a lot of different reasons. And so they don't mention it here what the particular reason is, but I'll give you a couple of ideas. Perhaps this purchase order is for a series of transactions. Perhaps there's an initial large transaction associated with this purchase order, but perhaps maybe 6 months down the line, let's say we've bought something and now they're going to come back 6 months later and do some maintenance. So perhaps in the original purchase order, we set aside enough for the original transaction and for the maintenance that's going to happen in 6 months. So we're leaving that balance encumbered because we know there's going to be another invoice against that purchase order at some point in the future, right? So we're just saying, okay, there's more to come, and we want to leave that encumbered because we've already set it aside for a specific reason, and it just hasn't happened yet. And so we leave that encumbered, and therefore the balance is a reduction of the 35,100 and the 38,000. Now, it could be we get to the end of the year and no additional invoice has been issued against that purchase order, and therefore we can release or clear that encumbrance and just start over at zero. Or if we actually think that no, this purchase order is going to carry over into the next year, we can honor that and carry it over. Now, the technicalities of carrying over an encumbrance, I'm not too worried about, but I want you to be able to look at these three journal entries and be able to understand what the debit and credit is for any particular transaction, any one of these transactions. But that's sort of the explanation, that you're really matching expenditures against appropriations, but before you actually authorize the expenditure, you're going to initially encumber it to set it aside, and then you're going to spend that when you get expenditures as you come down the line. And for many people, encumbrances are they're very useful, or they're kind of a little complicated to understand. So I'll leave it right there. Those are going to be the couple of journal entries I would want you to be able to know, or at least understand. So how do you, once you have, let me look at the first one. How would you set up the budget revenues and the budget appropriations? How would you be able to record that? And then how would you look at the revenue ledger and say, what is the collections versus the budget estimate? And the last one would be how to encumber how to encumber appropriations and how to match expenditures against appropriations. So those would be the kind of couple of journal entries. And when I post the homework, I'm going to try and make sure that I stick to just those couple of types of journal entries. Okay, let's see. I think that covers everything that we have here for this chapter. Hopefully your eyes aren't hurting too bad. Do you have any questions at this point? And let's see, we have gone for right about an hour. And so what I'm going to do next is once I get everyone to sign off, I'm going to go ahead and record the first part so that it'll be kind of a strange posting. But for those people who couldn't make it tonight, they'll at least get the full version of, or somewhat of the full version of the lecture. Okay, well, I'm back again. Thank you all for being here tonight. If you have any feedback as far as the different way that, oh, you know what? One thing that we didn't do, we didn't look at the questions. You know what? Do you want me to go over the questions, or would you like to do them on your own and see if how well you do against them? Let's see. I think I've got not that one. In the government-wide statement, so I'll just read through them quickly. In the government-wide statement, expenses and revenues for general purpose government are generally reported by, the answer here is going to be by function, unless they have some other thing that they're doing. That's typically how they report. In the government-wide statements, depreciation is generally classified as remember we said depreciation would be tied to an asset. Assets are typically tied to functions. Therefore, the depreciation expense is a direct expense, meaning it would be included typically, unless something else was, unless there was additional information, it would be considered a direct expense. In the government-wide statement, special items are reported before extraordinary items. That's true. Remember, the special items are the ones that are within management's control. The extraordinary items are the ones that are not within management's control, and so they're listed. And I'll just point out, even though I didn't think I mentioned it, special items, it's sort of a minor detail, but the special items can be unusual or infrequent, whereas extraordinary items are, I always say extraordinary. Extraordinary items can have to be both unusual and infrequent. Under fund accounting, under fund modified accrual accounting, deferred inflows increase fund balances. Well, if you go back to the how a fund balance is calculated, it is assets plus outflows minus liabilities and inflows. So inflows actually are a decrease in fund balance, and so this would be a false. Inflows decrease fund balances. Quote, represents the cost to purchase a good or service is the definition of, well, it's not an expense, right? An expense is what is consumed or used up to generate revenue. It is not the cost to purchase a good or service. So here, this is a definition of an expenditure. Normal balance for budgetary appropriations is, well, remember, appropriations are estimated expenditures. An expenditure is like an expense. An expense is a normal balance of a debit. Therefore, budgetary appropriations are the opposite, which would be a credit. Let's see if I can show that. You can see here budgetary appropriations. Well, it's under the credit column. Appropriations, normal balance is a credit, the opposite of an expenditure. Seven, if taxes are not expected to be available for use in current period, they should be recorded as deferred inflows. That was that one thing that was basically the one example we had of an outflow or an inflow in this particular set of, in this particular outline. The levy for extending city snow plowing to private streets is called a special assessment, because a special assessment is like a property tax, in that it's levied according to property boundaries, but it's not a property taxes to everyone with property holdings within the jurisdiction. Special assessment is just to a certain group of property holders based upon whatever the criteria or whatever the situation is. What transaction encumbers an appropriation? Well, we were just looking at that. What of the things happened that was actually encumbered the appropriation? So if I go back here, we can see what actually encumbered. The encumbered appropriation was the purchase order. Remember, the purchase order is our authorization to buy goods or services from a vendor, not for the payment of it, but for the sourcing of it. And so the purchase order is what encumbers. The invoice is what generates the expenditure payment. Last one, encumbrances will not appear in the balance sheet. So I think that's actually I may not have read all the way through 3-5, but you'll not find the word encumbrance it'll be in the notes or it'll be in associated disclosures, but the word encumbrance is not, well, first of all, it's not a GAAP or a modified accrual accounting term, and so therefore it is not, you won't actually find those in the balance sheet. So, because remember, this is something that we set aside funds for a certain use. And, I've said now several times that GAAP, that's when I think one of the shortcomings of GAAP is it doesn't have that sort of thing. There is no mechanism in GAAP to set aside funds for a certain purposes. So even though we have that in governmental accounting, it's not GAAP, it's not modified accrual, and therefore encumbrances do not appear in the balance sheet, even if they do show up in notes or other disclosures. Okay, well, those are the 10 questions. Hopefully, those are understandable, my explanations. If you have any questions, I'll post the homework. Probably not tonight. I'll probably get to it till tomorrow morning. But I'll post the homework and it'll be due next Friday like we normally do. And I can't think of anything else at the moment. I don't think there are questions. So everyone have a good night, and I will talk to you soon. All right. Thank you.